Financial Cycles Summit. This is day 2 of what is already proving to be a very exciting review of global markets by leading cycle pioneers, our FSC board members, and keynote speaker that we just heard from yesterday. A big welcome to all of you that are joining us again. Be great to hear from some of you in terms of feedback from yesterday's session, key insights that are top of mind, and any latest market views that each of you have as the markets continue to ebb and flow. We still have key market proxies at make or break levels, single stock names nosediving over the last few days, and then various commodities popping to the upside. So a very exciting time for us to be asking these questions about markets. We continue to have a highest ever record sign up. So a big thank you to all for collectively demonstrating interest in both cycle work and the FSC. And of course, for the remaining part of our event, we have still 4 more speakers lined up as part of a 6-speaker jam-packed conference. So just before we kick off, please, as part of our traditional FSC social connection at the very top, I'd like to encourage you just to remind us which part of the world you're in. That's also a good blueprint for all of you to reference in terms of just how global cycles analysis is. Share your market cycle views, and then any key insights from day 1. Remember, Peter Aladdis was talking about his view on US equities markets with the bear case scenario, highlighting that thematic question on AI and how that impacts potential cycles and trends. And then our FSC board member, Jake Bernstein, gave a marathon race across all key markets, equities, commodities, currencies, and fixed income, giving his broad-based view. It was interesting that we did have a contrast bull and bear view on risk proxies like the US equity markets. That just demonstrates the variations of views that can be shared, especially when we're dealing with different cycle approaches and different timeframes. So I'm just reading from the chat here. We have Elliot W. from Germany, Robert from near Atlanta, Ed from Netherlands, Adil from Switzerland, Mary from Florida. So we have a real mix here from the US, Europe, and from other parts. And our fellow team member, Dr. Barton from the US, just saying hi there. Okay, so let's push forward. Today, day 2, we are leading with FSC Development Director Lars von Thienen, who is getting ready as we speak to go live in discussing the duration of the current Bitcoin bull cycle. Second $1 million question, as we were just discussing now in the green room. How much longer will the good times last? Or as I like to say, when does the music stop beating, or when should we take care with those long positions? So we'll be hearing from Lars on that. I don't want to steal his thunder. Lots of interesting insights that I'm sure he'll be sharing. And as a preamble to Lars's presentation, just an overview of his professional background. Lars is founder, CEO of a knowledge management company. Von Thienen develops algorithms and software for cycles recognition. He has published 2 books on cycle analysis and invented a standalone desktop search and knowledge management app. Watch Von Thienen on Market Cycles Report every Monday at noon Eastern Standard Time. I know many of you will already be familiar with that show. And then to follow, we do have our FSC chairman, Dr. Richard Smith, on short-term cycles in US equities. Okay, Lars, over to you. We're excited to have you on. Welcome.
Yeah, hi Ron. Hi everyone out there. So nice to be here again and happy to have another episode of our yearly summit. So thanks, Ron, for having me on.
Where in the world are you from today?
Yeah, today I'm in Denmark. So normally I would be in Germany. So, but these days, I enjoy some time with my family here in Denmark. So the surrounding might be a little bit different today.
Very good. Over to you, Lars.
Yeah, thank you. So today I want to talk, as always, in this financial summit about Bitcoin. And I want to update ourselves on where we are in regards to cycles in the current Bitcoin rhythm. And I mean, we all know that we are in a kind of upswing since last year already. So the big question in regards to cycles is, will that upswing cycle continue? And if so, when to expect it maybe to end? So that's the key question I have prepared for today. So let me start to share everything we need. So just give me a quick confirmation that you can see what I want to share. Ron or someone else, just give me a quick.
Oh, all good, Lars. The screen and
Okay.
sound is good.
Thank you. So feel free to interrupt me at any time. So if important questions rush in, I'm just not able to spot them while I speak, but I would be able to take them if you would like me to. So how much longer will the current good times last? If you are aware of our financial summit, you know that this is, I think now the third or fourth time I will speak about Bitcoin. And therefore, I will do, and I promise I will do a very quick recap of the original findings, because these findings helped us up to today, to keep us in the cycle, the downswing and the upswing. So maybe to say also, never change the running system. So as long as the cycles work, we just need to be aware of the dynamic nature of these cycles. And this is the first time. I mean, you're all aware. You are always responsible for your own actions. So this is just my personal view. By no means any recommendation, what you will see now. Okay, so the findings, which I will share here in a moment, and that's important just to recap upfront or even to warm up, have been based on researching all previous parabolic moves we had in Bitcoin. And by the way, that's also a very fascinating topic, because you don't have much assets which have these kind of often or quite regular parabolic moves. And these parabolic moves always have two sides of the story, right? So right now we're looking at the left part of these parabolic moves. And if you look today at the Bitcoin chart, you might not even be able to spot them. So I would recommend scroll back into the year of 2010, and let me put up my pointer here. So where Bitcoin traded at around 0.2, and we had these up move to 28 US dollars. And that's the first parabolic move starting in 2010, then 2013, the next one up to 230, and 2014, the run up to 1,200. So 217, the run up from 200 to 19K, and 2021, and that was the first time I did speak about Bitcoin. We had the run up from 3.6K to 60K. That's one part of the story. The other part of that story is at the right side of all these parabolic moves, Bitcoin lost around 80% right afterwards. So it's not shown on the chart here, but you see what happened after these parabolic up moves. 2011, drop of 90%, 2013, drop of 70%, 2014, drop of 90%, 17, drop of 80%. And now we have it in the books, but this is the original slide from 2021. We have been in that quite upswing, and we now are aware of what happened afterwards. We again dropped from 66K down to 17. So again, we dropped 80% after that parabolic move. So it repeats over and over again. And that brought me to the point of cycle analysis. Let's check before all these up moves happened, these parabolic up moves have there been dominant and important cycles before the final up move happened, which we would have been able to spot, to apply cycle analysis? That was my point of research back in 2021, and I will now get back to you with the findings just on one slide. I spent 1 hour in total to reveal these findings, so it's just on one slide and 2 minutes. But the key finding, and that's a key slide here, because this works up to today. This works up to today. And let's go through them. So first, at each of these parabolic moves I showed you, there was a 200 days nominal cycle in that asset visible. So a clear dominant cycle. I say nominal 200 days cycle because it was not exact 200. So each year it was 190, then 210, but always around the nominal length of 200 days at each of these parabolic moves. And if you think, what's that? Rewatch the 2021 Financial Summit. I have gone through every parabolic move at that time to show you this nominal 200-day cycle. But and even more, once then I reanalyzed all these parabolic moves and the 200-day cycle, I always realized that there's a connection between these parabolic moves, that the final top of, or the ending of the parabolic up move, so here the final peak of these parabolic upswing here, always happened at the 5th repetition of that 200-day cycle. By the way, to the time scale here is just schematic, so the swings here are not aligned on the time scales, just to show you the principle. So you could count that the fifth repetition of that 200-day cycle always have been where the key peak or the end of this parabolic up move happened at each past parabolic move since 2010. And even more, we know that after each of these cyclic upswing, price lost 70 to 90%, and exactly this is what happened after the 2021 up move. And there was another finding that when will the downswing, so the right side of that parabolic move, come to an end price-wise? So when will it reach the bottom? And this was always the case after the 3rd repetition of that 200 nominal day cycle. And it's shown here in simple terms. So you count the tops of the 200-day cycle, 1, 2, 3, 4, 5. That's the timing for the final peak of the parabolic move. Once this is in, you just count the bottoms, 1, 2, 3, and this would give you the timing for the expected low. These findings have been published or made public in the Financial Summit in the year of 2021. And now you might ask, how did it work out? So a quick recap. So this is just a live screenshot from that presentation. It's public, it's there. You see how I put it on the live chart here. So this was the latest data point in June, so same period, summer 2021. And I put it to the chart. So this is the expected 5. So we would expect another upswing. First conclusion, second conclusion, after that point in time, please expect a drop of 80%. So this was ahead of time. You know what happened. You can go to the chart. So this was, the presentation was in June, that point in here. So Bitcoin has gone up to the final top. We dropped 80% down to 16K from 70K. So then we had our Financial Summit last year in January. That's where, Ron, you mentioned that, the $1 million question, when will the winter end? By the way, I never received my check on the $1 million question, but okay, I'm still here. So let's see. We went up. I mean, we know we went up from this point in time. We are now back to 60, 70K. So no surprise, this model worked quite nicely. That's why I said never change the running system. And to be honest, for myself, I'm surprised how exact that model was able to time the top, the bottom, and keep us still in the up move until today. This does not happen so often, but maybe it's also the benefit if you put a lot of research to discover these kind of patterns, you will be rewarded. So let's see now. Okay, that's the model. That's the framework. Now let's fast forward, and that's why you're all here, to today, June 2021. I have prepared, I call it main chart, because I will show you much more today than just this cycles model. I mean, would be quite boring just to repeat what I did in 2021. So let's add a little bit more to the mix, in addition to never change a running system. It's quite easy. So here you have everything in front of you. So maybe now it's time to make a screenshot for everyone out there. That's the key chart for the next 30 minutes. And I will walk you through step by step. So within the next 20 to 30 minutes, you will get a complete understanding of what you see here. But there's a lot on here. And let's start and I will walk you through step by step. And at the end, I will come to the conclusion. So don't get confused right now. Please follow me. Follow me, relax, take your beer, coffee, whatever. Just listen and watch for the next 20 minutes to get a clue. The first topic I want to explain is this gray, looks like a zigzag line here on the chart, with this a composite cycle model. It's just plotted as just connecting the tops and bottoms from that composite model. And I will switch to that composite model first. What is that composite model about? And hey, Lars, you told us about the 200-day cycle. Why are you now showing a composite model? And what is this zigzag line, which then continues into the future, which is the composite plot, about? Okay, so let me explain that first, and then we get back to the chart. This zigzag plot line is the dynamic cycles model. It's just based on 2 cycles, but it is mainly the 200 nominal day cycle model, nothing different. Let me tell you why. This is the spectrum analysis from today's Bitcoin price chart. I have just zoomed into the spectrum view of the analysis. But if you would pull up Bitcoin a daily price in our cycle analyzer at today's point in time, you would see that spectrum here on the screen. And if you know how to read a spectrum, we are looking now for the key peaks here in that spectrum. And the key peaks, if they follow certain measures, are then called what we call the dominant cycle. And these kind of dominant cycles are then used to point into the future or do a projection with that dominant cycle. So, however, what we would look out for is, about the nominal 200-day cycle, which would be here, this dotted line, or where my cursor is. So we don't have a clear peak on a 200-day cycle. We would have to choose maybe a shorter one or maybe a slightly longer one. And even this is not a satisfying opportunity here, because we have 2 other even bigger or more dominant cycles at the current point in time. So that's why we need to spend some time to digest this spectrum and how to work with that. But there's something, if we spend some time looking at that spectrum, you would see that the most dominant cycle, without any historical knowledge about, would be this one, which has the highest amplitude, clear peak, a green triangle, a big triangle. And if you read here in the table view, this would also be picked by what we call AI or Copilot, which helps us in identifying the most dominant cycle. If you don't have any knowledge how to read the spectrum, this is the ranking mechanism we provide here, which is 375 days. This is exactly this cycle here, which is currently the most dominant one. So this is not the nominal 200-day cycle we would expect, or we quite need, if we want to continue that framework, that pattern, or if we expect that pattern to repeat. But if you do the math, so now divide 375 by 2, where do you arrive? Someone putting in the result? 375 divided by 2. Can't hear you.
We're polling them now, and hopefully we'll get a response soon.
Okay. I will wait.
Richard has just shared his insight, along with Ed.
Okay, what's your finding?
So we have a range of 187.5 from Richard, 200 Dave from Ed, and AO. AO is saying close to 200, and then also suggesting the harmonic relationship, which is key.
Yes, so I mean, for sure, that's where we are. So divided by 2, you would arrive at approximately, not exactly, but the 186. Yeah, is what I call the harmonic relation divided by 2, or the harmonic relation of 2 would give us exactly the 186 days cycle, which is not listed here. So this is exactly this peak here, which is not the most prominent one if we just want to spot one. But this is the harmonic relation to this dominant cycle. So again, here we have the nominal 200-day cycle, which is still there. It's not so obvious to spot because here it is shown in the harmonic relation of 2, which then reveals as the most dominant cycle with a length of 375. But I would call it's again the 200 days nominal cycle in its current form. So today's form, I mean, we deal with dynamic cycles. They are never static. So where the child is 186 and the parent maybe is 375, but they both relate to the nominal 200-day cycle. And that's why I have picked or chosen these 2 cycles now to create the composite model, because I think I would not pick the 278 because I stick with the most important one. So there's no individual judgment here. I go with the most dominant one, but then I add the harmonic relation because I know from historical analysis from each important market top and bottom that the 200-day cycle was always the most important one to follow. Call it persistence, call it historical knowledge. So this is the kind of additional information you would have to use as a cycle analyst. But anyhow, I'm not diverging here from the path how to choose a cycle. So that's just upfront. So, and if you now do the composite plot based on these 2 cycles here, so 375 and 186, again, I hope you got it, which is still the normal 200-day cycle model. This is the composite plot you get here in a cycle form or cycle shape. And if you would measure the distance, so to be honest, there's still the 186-day cycle here because the big swings here, yeah, this is related to the 375. But if you just connect or measure the distance here from that top to that top, from that top to that top, or from that low to that low, or to that low to that low, the main rhythm is the 183. So the phases are not so divergent that they cancel out each other or that they would form a crazy shape with these 2 cycles. You clearly see the both rhythms which at one specific point, they just add up from the amplitude point of view, but the key swings in regards to timing have the main rhythm of the 186. So we spot the main rhythm of the 186 days. So it's also seen here in that high. So the timing is perfect even from that, and we don't care about the amplitude fit here. It's the timing of these cyclic rhythm here, and you see the subharmonics of it's the key cycle still. If you check all turns are related to the 186, not the 301. So okay, we are here in that cycle. So this is where we are today. So we might face a challenging summer period. So this is just looking at that cycles model, and then another upswing into early 2025, or even maybe there is an interim peak here somewhere late summer and then early 2025. But however, don't see these cyclic swings in isolation, because we need to apply the count of 3 and the count of 5 to check, okay, was this top here, was this already the final peak of that move? Or do we expect another high or additional highs to follow in Bitcoin before we might maybe see a correction of, again, 80% or something like that? And therefore, we apply the count of 3 and the count of 5, which is not seen here on the chart, but I will come to that in a second. I just want to explain, this is the composite model I use on that chart, just connecting as zigzag lines on the price chart, because we are just interested in timing and not the cycle shape. And just using the 200-day cycle. So let's get back to the price chart. So this zigzag line here, which you see, is exactly that cycle model you just saw, derived from our cycle scanner, which I showed here, the summer bearish period, and then the key top expected early 2025. I hope now you understand where the cycle model is coming from. Now, let's apply the count of 1, 2, 3, 1, 2, 3, 4, 5. And I've done this here. So these indicate the key 200-day cycle. The red one here is the nominal 200-day cycle, so the ideal cycle. I just kept it, and this was also the original chart I showed the past years. However, as we deal with dynamic cycles, you need to adjust it to the current dominant cycle. And this is 186. And I hope you got why I choose 186 now, because the key swings on price are based on that harmonic subcycle, not the 375. It is still the nominal 200-day cycle. And it is aligned by the, so I have aligned this 1, 2, 3. This is the low. So you align it here at the at the key top, and then you count the first bottom, second bottom, third bottom. So that this is why we have the timing. By the way, that was also why I told early 2023 this is the end. And now let's count the tops. So this is the first top here, this is the second top here of that cycle, and this is the third top. So we are currently at the third repetition of that top. And if this pattern will continue, we need to have 2 more repetitions of that cycle. So, and I've indicated this here at the bottom. So count 4 is still up to be expected. Count 5 is also still up to be expected from timing. So, and this count 5 is exactly the timing projection now, early 2025. So, and in these kind of parabolic moves, trading these interim cycles here, or even this negative cyclic situation here, I mean, who wanted to short NVIDIA in the past year, even though there might be downswing periods? So the key takeaway just on the cyclic model is that the upswing, the summer, the good times, the music will play until early 2025. So yeah, maybe there's a hangover in between. We need to take a pause until the party can continue the next day. But I don't know how to time that. The key reading from the dynamic cycles is this pattern, never change a running system, might continue into early 2025. So this is still intact. It helped us timing the top, timing the bottom. I don't know when this will break, but for now I would call it valid and in action. So now you got the zigzag line, the cycles model, the count of 5. This is how I would see it now. Now let's explain the other topics you see here on the chart. So the next interesting point to address is, and that's this purple, lila, pinkish line, yeah, which you see here in April 2024. That's the kind of Bitcoin specific cycle, which is the halving event. You also see it here in the past, in the year of 2020. So 4 years ago, there was also an halving event. Here's the line, and here's the line. The halving event, and by the way, it's not 4 years, so it's not a time-based cycle. The the halving event is related to a kind of Bitcoin blockchain timing model, which is now not the normal time we would assume. It's 210,000 blocks being mined. When that has happened, the halving event takes place. So it's not a static point in time. However, as one block takes approximately 10 minutes to mine, and if you do the math, 10 minutes multiplied by 210,000, you will arrive at approximately 4 years. So in short terms, you can call it a 4-year cycle, while we deal here with the Bitcoin mechanics and the blockchain model. So let's talk a little bit about the halving event and that kind of halving cycle and what impact that cycle could have in addition to the dynamic time cycles. So therefore, I'm just referencing here existing research. This is a research where they analyzed all halvings which happened in 2012, 2016, 2020. So I think now we have 3 repetitions of that halving cycle, which is the minimum, which I would call we need as a minimum to have a valid a cycles model. But now it's the first time we have 3 repetitions of that halving in place. And what you see here is the 0, that's the day of the halving. These are the days before halving took place. And on the right chart, so on the x-axis, you'll see the days after that halving event. And on the epsilon axis, you see the performance factor after the halving cycle. So, and this is the median or the mean. But anyhow, they speak the same message. So there is a statistical significant pattern related to these 3 halvings, what happened afterwards. And if you zoom in, also what happened in the first 100 days. I mean, the current halving took place in April. I think we are still in that 100 days window. If you closely look here, the 100 days window, there's not much happening in the first 100 days after that halving. And you see the most statistically significant impact happens 400 days after the halving took place. Then when you really see this exponential growth and performance factor in past halvings. So the timing is aligned always at the point when this cycle started. That's 0. Here are some statistics I showed you already. So the days, the 100 days, there's not much performance. I mean, even 100% you can call it. That's great. But the real called here excess performance kicks in around 400 days after the halving. And that's their finding. That's not my finding. I've shown the source also here at the bottom of that chart. So you can always get back to the original article. But we have some timing indications here. So the halving cycle only becomes significant, and there's also some statistical measures in that study so that it is significant after these 100 days. So, and the key performance effect is to be 400 days after the halving. Okay, so that's why I put in that line on the chart here, and I have highlighted 2 interesting windows here. So this gray one, these are the first 100 days after that halving. And this is the point in time 400 days after the halving. And you see when this line, if you would not extend it to the top here. So this is exactly at count number 5 of, or close to count number 5 of the 5th repetition of the nominal 200-day cycle, which is today 186 days, which is also listed here by that composite model. So the repetition of the halving cycle is in agreement with 400 days after that halving is next year summer. You could do the math on your own. So 400 days from April this year is somewhere here, June, July. So that's the line. It's not the exact line, but I think you get the mass here, and we are in agreement. So it still confirms there might be a fifth repetition, and we are in the first 100 days window, which don't expect too much from that halving event. There's nothing in the first 100 days. So you need to be patient, but it happened at every halving. So you also see, let's look here into the past. This was the previous halving in the year of 2020. You also see during the first 100 days, there was this sideways move, nothing happened. And the real push upward, which kicked in. And you see this is the 400 days line. So really happened in the final leg of these 400 days cycle here. In the early time after that halving, I mean, you had mainly these sideways move here in Bitcoin, and then the big upswing here. So I don't know if this will repeat, but that's the halving cycle here. Okay. So now let's look at the top. I have put in another form of cycles, which is dealing with seasonality, or seasonality is mostly aligned with the behavior during the course of the year. So are there patterns or recurring patterns we can spot during the course of the year? And if so, this would create a seasonality rhythm which repeats every year. And now let's have a look at that research. So let's talk about seasonality in Bitcoin for a second. And there's different research out, so that's not my original finding. You can use different charts and research on seasonality, but this is the average. So if you would put all yearly performance from 2010 up to end of last year on the chart and build the average, so this is what the performance on average would look like. So for the past 13 years. So in short, you always see the upswing cycle, which goes from January into early June, then maybe more sideways summer period, then a negative period into September, early October, and then October, the next upswing kicks in, which is then running until the end of the year and continues then again into end of May, early June. So that's the yearly seasonal pattern in Bitcoin. It's another source, same findings. So it's I just want to reference two sources here. It's just shown here. So the key performance is from February, March into April. It's just charted in a different way. I have put this here on top as a line. So, but same as you saw on the other chart, then more sideways, slightly downward in the summer period, which is here. Then we have the negative performance in August, September, indicated here. And then the big upswing in October, November, continuing during December. So, but it's confirming that pattern here. So it doesn't matter which source you're pulling up. That's the seasonality that most will come up with. And putting this now also on the chart is the seasonality window here, put also in time windows. And let's start with the past year. So green indicates for sure the positive seasonality. The red indicates this small summer or late summer period. So the neutral period is the early summer. And then the late summer, that's the August, September, that's the negative sentiment. And then from October into April, May this year, that's the positive seasonality. And this is what we saw also in the recent upswing here. So a poor summer period, 2023. And then here in late summer, October, this bullish seasonality in alignment with the up leg of the 200-day cycle, and then now came to at least from the composite model, came to an end. And you see we are now entering also a neutral to slightly bearish seasonality pattern, which continues into August, September, in alignment with the cycle model here, also indicating the August interim bottom here in Bitcoin. So the seasonality is here in alignment with the composite model and also in alignment with the first 100 days after the halving. There's no impact expected from the halving event. So all three models are in alignment. So no good news for the summer for Bitcoin. But however, we are still in the long-term upswing framework where count 4 and 5 are out. So again, I would compare this. Trying to short Nvidia now could be quite heavy a topic. So shorting Bitcoin, at least that's nothing I would consider for myself right now. Maybe just a good spot to re-enter to prepare for the final up leg. But that's up to you. I just explained the cycles here. And now that comes interesting for seasonality. The next real interesting key seasonality kicks in October 2024. Yeah, that's here, October 2024. And now maybe we come to the final conclusion of my presentation. Maybe you will see it now on your own based on that chart. So we will have another bullish seasonality, which kicks in starting in October, running into June 2025, right? So that's the seasonality kicking in again, end of September, continuing through the end of 2024, going into June 2025. So that's the expected seasonality pattern. Coming into alignment with the final up leg, moving into the 5th upswing repetition of the expected cycle going into April next year. In alignment with the final timing window of the 400 days expected key impact pattern of the current halving event, also coming into alignment into April, June next year. So, I mean, this is really something I'm looking for. This is cycles within cycles, the seasonality cycle, the 200 days normal cycle, the halving cycle, all start to speak the same message coming up October this year, moving into June next year. That's what what I am preparing for. It's a great opportunity spotting here with cycles. I mean, they're all in agreement up to that point in time. So the summer period, yeah, it will be hard to time. Maybe you need more technical situations or trade short-term movements like Richard will explain later on. So the summer season, maybe it's just interested for short-term trading opportunities, imbalances, technical situations. But if you're looking for midterm projections or at least opportunities, that's the cycle I'm now looking for. And if that happens, I mean, it would be the 3rd time this model works out. And I just pulled in the seasonality and I pulled up the halving event to see how the other cyclic models related to Bitcoin would fit into that model. So yeah, that's it. So I think we have 15 minutes now to take some questions if you would like, but that's the key chart. So print it to the wall, make a poster out of it. Let's monitor, at least that's what I will do. Let's monitor now the summer period. Let's prepare for the final bull run, October, June 2025. If this repeats, and I have no clue if this will repeat, I think next year we should be above 100K very easily. But as said, nobody knows if this will work out. Every cycle model will fail at some point in time. But at least we had a great running since 2021, where I put out this model the first time. But that's it. I hope you got the message. I hope you know how to read that chart. I hope you can use that chart for your own analysis now. That's what I have for today. So happy to take questions.
Great insights, as always, Lars. I enjoyed that very much.
Thank you.
Opening question to set the stage and to also perhaps guide the audience. on your learning path and the research that you have done this time, building on the previous, which is always a great consistency about your presentations, Lars, if I may say. This time, the second $1 million question, and I believe the check might be in the mail at some point in time. Humor between you and I. But the opening question is more about this whole concept of dynamic cycles, and it may be a simple question to ask, but for those who maybe are hearing that term for the first time, or maybe they've heard of it already, but maybe are also asking about the benefits. In your experience, Lars, how would you define it, and what are the benefits?
Yeah, the benefits is that in the past, or most times, most people deal with static cycle. Even the Hurst model or Dewey, they all try to find static or fixed cycle models, which is great and which is important. But we always talk about, nature rhymes, so they will not come in this exact repetition as we have seen that in the past. So, and the dynamic nature is more, how does it rhyme today? What's the current rhyming of that cycle? And therefore, I think that's where we have the new digital signal processing tools at our fingertips right now, which Hurst Dewey didn't have at that point in time. So I would not blame them for that. But now we have those tools, and these tools help us to kind of zoom in the what I call dynamic behavior is what's the current alternation or variation of the length, the phase, the amplitude. So the cycle always consists of these three measures. So an amplitude, the length, and the phase. So where are we in that cycle? And this is not consistent and static over time. And if we are able to zoom in the specifics of, okay, what is the change in the length or the phase, it does not help us in detect better cycle lengths in the past, but it would make the projection into the future more specific, more exact. So that's the key learning or finding I have. It might not make the average cycle model to fit to past data better, but this dynamic behavior helps you to pinpoint what is expected in the next leg, and you should never plot a static cycle infinite into the future. I'm only looking in the dynamic cycle when is the next turn of that cycle expected, and there, these bringing in the dynamics helps to get a better understanding on the next turn, not on the next 10 turns or the past 10 turns, but I don't care about the past 10 turns and the next 10 turns. I want to know even more exact when the next turn will happen. And that's the dynamic topic. And digital signal processing helps us to derive that.
Thank you so much for the clarification of both the definition and the benefits. It's a broad-based question, but has much complexity to it. So wonderful that you could simplify it in the time that we have for those that are thinking the same point. A follow-up to that, Lars, is what is very exciting to now see you share a broad range of different cycle methods as part of a layered process within cycle research, which is something we celebrate here at the FSC in terms of the sum of all the parts, each of us as part of the team, but also the speakers that we invite, the members that are part of the community, all do cycles, but with their own variation. And of course, they will use the FSC cycle model based on digital signaling, but also things like seasonality, natural cycles, and perhaps other things. So on that point, Lars, what was your experience of using 3 different cycle data points? So the FSC cycle model, digital signaling, but also seasonality and the halving cycle data. In your experience of doing that research and presenting it to today, what was your experience?
Yeah, so seasonality, it is important. You just need to have enough historical data to really use seasonality. And that's anyhow a key topic we might have with Bitcoin or cryptocurrencies. Often, maybe we have 10 years of data, but that's maybe okay to start seasonality. That's why I didn't pay too much attention on Bitcoin. But this does not mean that seasonality is not important. Seasonality is important, especially if you have more historical data where you can derive seasonality from. And that's also, before today, I have never paid attention to the halving cycle, because I was thinking, yeah, well, there have been just one or two events in the past, so you cannot conclude any cyclic behavior just on one or two events which took place. But now, as we have 3 repetitions in place, this is what I would count as a minimum. You need to have 3 repetitions of whatever, a seasonal cycle or that special halving rhythm. If you have this minimum of 3 repetitions available, it makes absolute sense to have this different view from different method frameworks. And that's why I like being part of the foundation. So as these are special expertise, and my expertise is mainly the digital and the dynamic part. So therefore, I need to pull in other references for seasonality or other cycles. But then it helps. So you don't need to be an expert in all areas. If you know that, or if you need to accept that maybe you're an expert, each of us is an expert in one specific area. And then you pull in the other results from seasonality, from specific cycles to that asset class, like commodities have also special separate cycles. Farmers have special cycles for the 4 seasons happening, whatever. So you need to bring them in. Never just use one cyclic model. That's my learning. And if they align, then anyhow, that's the only point in time when I take action. If they are in disalignment, or if they disagree, then I don't do any decision making or trading decision based on that. I would like to find these opportunities when different cycle models show the same alignment. And that's why I put this out. This is what is happening again, end of this year, early next year.
Such a key point in terms of the importance of alignment. And of course, at times, even when we're using non-correlated cycle data, we can get lead, lags, divergences, and in the rare occasions, alignment, which of course creates that high probability setup.
Yeah.
What was interesting is that despite using different cycle data points, FSC cycle model, digital signaling, seasonality, and the halving cycles data, which I found very insightful that you mentioned, it's not based on the 4-year fixed cycle, it's based on the actual blockchain model. But the follow-up question to that is, you also applied the principle of the pattern of cycles, so 3 cycle repetitions. What was your point about 3 and now extending to 5, and how that may have a projection for Bitcoin into next year, that second $1 million question?
I have no clue why 3 or 5. It's just a pattern. It's there. I just spotted that pattern. So there's no reason why I have looked out for the number of 3 or the number of 5. I would always question, that's similar to Elliott waves. You have this 3 up, 5, and might be, but it has nothing to do with that other framework. So the only reason was I was looking for patterns. That's just it. And I would say, or to conclude, that's the reward if you spend lots of time just looking at these cycles. And I mean, as a researcher, you are sitting in front of that data, looking at that data, and often just, what do you want to tell me? And this is what I did. I was just sitting in front of all these parabolic moves, having all the cycles at the bottom, just thinking, is there anything? Is there nothing? And then just by seeing, by analyzing, investing time in that, I found, oh man, let's count that. That's 3. That's 3. That's 3 repetitions again. So it's just research, not pattern detection in digital terms. It was just, I think, the reward to an researcher out there, and what's even more important, so we shared it with the public. So it's time-stamped, and it's in. So, but the simple answer is there is no reasoning why 3 or why 5, or if there's a reason, I don't know the reason for it.
Interesting to hear you share your thoughts, and it's that kind of humble research state of letting the data speak to you after doing the analysis, and of course there were some Elliott wave practitioners that did suggest the potential match with wave theory. We have AO here is saying the 3 and 5 repetitions of subcycles forming a major cycle could be something related to harmonic analysis in nature. Either way, he's saying love this analysis, and that it is his view of the world is aligning with your data research. So there you go, some vote of confidence from our audience. We also have a question from the same member asking, what about the 121 day cycle? There was a Bartel score of it being low, but in the shape in the spectrum wasn't looking too bad according to his observation. Is there a harmonic relationship with the 200-day divided by 2?
Let me cross-check.
The detailed question.
Yeah, okay, I see the spike. Yeah, I can quickly bring in. Let's discuss that for a second. Why not?
Thank you.
I just need to reshare that spectrum. So hope you can see that.
Yes, it's up on the screen. Clear.
120, and I think that's I've not the pointer on, so that's the pointer here. So this is the 121. So this was mentioned here. So this is a shorter term cycle here. Yeah, it's not a perfect fit, to be honest. I always pay attention to the screen, larger triangles and higher amplitude cycles. So that's why I put more attention here. If in a secondary view, from a spectrum point of view, the peak looks very nice. So it's a sharp peak in the spectrum, to the left, to the right. The Bartel score is not as good. So we have really bad Bartel score, so the statistical significance is not as good. However, we have a nice strength value. That's okay. The harmonic relation, I'm not so close. So if you multiply it by 2, you already arrive at 240. So maybe at the edge. So that's why I call the harmonic relation is at the edge with 250. So now 20% deviation to the 200-day cycle. Not the best Bartel score. And from the amplitude, I think you should take the other ones into attention first. Then, and that's valid, then once you've done the analysis with the 375, the 186, then you could, in addition, look at the 120 days cycle and check if it is in alignment. But I would not just look at the 121 day cycle on its own, as I just tried to explain why I think it's not a perfect match. And it's also not chosen by our AI system here. So up for discussion, but I try to share my views just quickly on that.
Great to have the practical hands-on check on that spectrum analysis, and also good to see eagle eyes in the audience. They're watching on the edge of the seat. So all good. We have a follow-up and final question, which is probably a grand finale question in itself, in terms of price target on Bitcoin. In your estimation and analysis, what could be the price target projection for a top, I believe you mentioned a high in April to June of 2025.
Yeah.
Percentage move, price targets,
the key,
whatever it might be.
Yeah, I will talk on that for some seconds. But the key disclaimer I need to make upfront: the timing or the dynamic cycles I use are only used for timing, not doing price projections. So that's upfront, the cycles model I'm using. However, I like the question, so so the price target I would derive, and I showed that also. Let's bring in that chart again. I showed you from the halving cycle. So we have some estimates or references from what happens after the halving, or 400 days after the halving. Let's bring in that chart again. But I even don't want to spell that number. But this is what the halving cycle suggests to arrive if a parabolic move would repeat. My personal view is, that's my personal view, without any scientific analysis, I think we should be above the 100K mark next year. I think where a parabolic up move will end, nobody is able to give a target on that. I mean, that's the statistics on the halving cycle, and then do the math on your own. My personal, not the target, but a minimum level I would see to pass through early next year is the 100K mark.
Thank you, Lars. Always one of those challenging questions to close on, but certainly top of mind for others. And a great point. This is timing based on timing patterns, not price magnitude. But interesting external research there, along with your own view on how high Bitcoin can go.
Yeah, and I see just a comment. I see in the comments from Imikilo, you could use the FLD to that. And Peter was here yesterday. Yeah, thanks for bringing up that question. So that's exactly, but I would leave this now to you or to the audience or to you. Use the concept of future line of demarcation, FLDs, or review Peter's talk from yesterday, as he's the most expert on the method. But if you know the 200-day cycle, that's exactly what you should do. Do the 200-day cycle, use half of that, or the 186 in specific, or the 374, divided by half, extend price into the future, check if the price will cross above or below the line, and then you can use FLD to draw price targets. Thanks, Emilio, to bring that up. Yes, it's valid.
Thank you again once again for the insightful session. Enjoy your time in Denmark, and we look forward to seeing you for the weekly special on FSC Cycle TV.
I just need to excuse for the lighting, but we have sunset here, so it's getting dark.
It's a great thing. Sunset has happened earlier on my side, but great to see it on your side.
Yeah.
See you again.
Yeah. Thanks, Benjamin. And have a nice evening. And bye to the audience. Would like to see you soon.
Take care. And now some brief FSC messaging before we hand over to our next speaker, Dr. Richard Smith, FSC chairman. Join FSC, learn more about our benefits and its privileges. Remember, as part of the greater good mission, we are a non-profit group. The work, including this event, is made possible by membership dues and donations. Explore FSC membership privileges. There'll be a link shared in the chat for more info. And then, of course, for those of you who are new to the FSC, the very simple thing you can do is select the link in the chat for our free FSC newsletter. And then, most importantly, exciting things to look forward to in the rest of this year of 2024, an online course in cycles, more to follow, masterclass in cycles analysis for crypto, and then also a new edition of the venerable Cycles magazine coming back to you soon. Now onto our follow-up speaker, Dr. Richard Smith, chairman of the FSC, will be focusing on short-term cycles in US equities. For those of you who may already be aware, Richard is now complementing Lars's weekly segment. I believe on a Tuesday. He can speak a little bit more on that. Short-term cycles across many different markets. Richard is a financial technology pioneer, founder of Risk Smith, a risk management app for retail investors. As the former CEO and founder, he grew trade stops to more than 30,000 retail investors who entrusted his technology with a staggering $20 billion. He has been featured in Business Insider, Market Watch, Forbes, CNN Business, Newsweek, Money, BBC, and more. Richard, wonderful to have you on. Welcome.
Thank you, Ron. It is great to be here and great to follow up on the work of Lars. And today is really, in a way, today is Dewey Day, if I may call it that. Because what we're seeing in Lars's presentation, what we're going to be talking about in my presentation, is the technology of, Lars is better at this than I am, Edward R. Dewey, right here, Cycles, the mysterious forces that trigger events. So what we're digging into today is Dewey's technology, the foundation's technology, brought to life, particularly by Lars. He's done an amazing job. But really, that's what we're seeing today, is this technology that is at the heart of the foundation, that has been developed by the foundation, and excited to continue moving forward with that here now. So,
we have a few people, Richard, in the chat saying, love the book. And of course,
yeah, it's a
good
phenomenal
plug
book.
moment.
You know, I really feel passionately about it, that Dewey deserves a lot more recognition than he's gotten so far. So it's great to bring the book back out. It's great to read it. It's great to see all the things that he talked about, 50 years ago that are being pursued by many people today. So
over to you, Richard.
All right. Well, thank you. Just a shout out to Lars. If you love Lars, give him a shout out in the chat there. He's done a phenomenal job for the foundation. He always presents incredible research, such high integrity. So thank you for that. And it's great to be here. Great to follow up with everybody and dig into a topic that really I haven't seen anybody else cover, which is intraday cycles in markets, particularly the futures markets. I can tell you, I have been trading cycles now myself for over a year in the futures markets. It's not the only thing I do, but a lot of people have been asking me, where have you been? What are you doing? Well, I've really been putting my own technology, my own methods to the test with my own money, because I want to make sure it works. When I develop technology and bring it to other people, I need it to be validated. And it's been working. And cycles have been a very important part of what I've been doing for well over a year now. I would not be doing as well in the markets as I've been doing without intraday cycles. So I believe intraday cycles are present. They work. It's difficult to, it's hard work. Just like Lars said, you saw that chart he put together. That was a lot of hard work. It is hard work to trade cycles intraday, but it can be done. And I do think it can be fruitful. And I think we'll also just continue to learn how to use this technology that Dewey developed and that Lars and I have continued to enhance. And whether you're doing intraday cycles or daily or weekly cycles. So we'll continue to dig into the technology. So with that as preamble, I promise I'm going to show you some things that you've never seen before. I'm going to show you some real cycles I'm using every day in the markets. I do need to give a little bit of a preamble, especially for anybody who's hearing me for the first time. So bear with me as I talk through a few points here. Actually, let me make an adjustment here first. All right, I think that's looking good. Now then, where are we? All right. So it's the mid-year cycle summit, intraday cycles analysis. Let's get going. Today, I am going to be talking about short-term cycle setups using intraday data, and I'm going to be focusing on US equities in particular, but we can look at other markets too. If you're interested, just feel free to ask questions. I'll try to keep track of the questions. Forgive me if I'm looking over here to see where the questions are on my second monitor. But I'm going to start out digging into US equities here. So my beliefs about the markets, I really believe that loss aversion, hopefully you've heard me talk about that before, but basically we hate to lose. So when we're losing, we take more risk. We're risk seeking when we're losing because we don't want to sell, because sell means loss. But then when we're winning, the fact that we hate to lose attaches itself to our profits, and we don't want to lose our profits, so we tighten up. We're risk averse when we're winning. So we're risk seeking when we're losing. We take more risk. We double down, triple down, turn a short-term trade into a long-term hold. And then when we're winning, we find all kinds of excuses to take profits and get out early, etc. So that's loss aversion. A couple of Nobel Prizes, Daniel Kahneman and Richard Thaler. And it really does drive short-term behavior in the markets. I think it's what drives the kinds of highs and lows that we see in the markets. Basically, smarter people, more mature market participants, capitalizing on the loss aversion of most of the other market participants. And we have to invert loss aversion in ourselves. There's a great book, Tom Hogarth, Best Loser Wins. Wish I would have come up with that title myself. But one of our mandates as traders is to be risk averse with our losses and risk seeking with our winners. Sell your losers, add to your winners. Markets defy expectations all the time. We have to expect the unexpected. We cannot, want to be right. You can want to be right. You can be right, or you can make money. Your mind, our minds cannot follow market behavior. We cannot predict it. Sometimes we just have to kind of anticipate it, get on board, and go for the ride. So Jake is very great at talking about that. I've talked about that with him for 25 years now. I know how important this is. I've seen it for 25 years. I've tested tens of thousands of portfolios. This is important stuff. And, I'm talking about trading. I have to level with you guys about how hard trading is and the things you have to do in order to be successful, because most people lose money. We're going to talk about that. So my trading approach, I'm looking to get on board big moves early, and I want to get off them before everybody else does too. I want to manage my exposure, how much risk I'm exposed to in the markets, and I want to make uncorrelated bets. I'm not going to talk about that too much today, but that is my approach to trading. That's what I'm doing. You'll see a little bit about that as things unfold today. So a few disclaimers, caveats, and notes. And it's important to me to go through these disclaimers. I don't want to just put, some legal boilerplate up and wink, wink and tell you, no, it's just a legal obligation. No, this is serious stuff. Trading is dangerous and hard. Take it from a first-person experience. Do not take it lightly. Most people lose money with trading, especially with leverage. We're talking about trading futures here. Most people lose money. Buying or selling decisions are solely your own. I cannot tell you what to buy, what to sell, when to buy and when to sell. I can share with you what I'm doing. I can show you how I use tools. You ultimately are making your own decisions. And if you're whining about what somebody else did to you because they didn't give you the right forecast, you're going to be a loser. So that's partly in response to some of the people that were chiming in yesterday. I hate when people come on YouTube and trash people who are giving free advice, on YouTube, just because they had a bad experience with one of that person's predictions. It's hard to make predictions. Nobody comes out and says, I know the future, or if they do, you should not give them your money. But really, the main point is that you've got to own it. We've got to own it. You're not going to be successful if you don't own it. This is not professional investing advice. It's educational. It's free. Okay. Your situation is utterly and completely unique. A caution here, especially at a summit like this, one of the things I've really settled on is that too many trading ideas is a recipe for disaster, because we can talk ourselves into anything, right? So ultimately, my follow-up point here, you're going to be successful when you settle on a simple system with good risk management that is aligned with your situation and beliefs. So I'm going to be showing you some new things today. Maybe they're new to you, maybe they're not. If you can incorporate them into what's working for you, fantastic. Don't take them as magic bullets that, hey, Richard said this is what's going to happen in the stock market. It won't work. It just won't work. Your biggest enemy by far are overly optimistic beliefs, and you will be inundated with them, right? It's the world is full of people selling the idea that, the future is more predictable than It really is. And that's overly optimistic beliefs, OOBs. And just keep that in mind. All right. This is a little study out of Brazil. You can look it up. It's academic study. 97% of all individuals who persisted for more than 300 days in the futures markets in Brazil, trying to day trade for a living, lost money. Only 1.1% earned more than the Brazilian minimum wage, and only 0.5% earned more than the initial salary of a bank teller. So maybe, less than 0.5% actually earn a living day trading. It's hard. You have to have capital. It's serious stuff. And at a minimum, I don't want this to discourage you from trying, but I just want to be realistic. I don't want to have overly optimistic beliefs. I want you to be in the right state of mind to learn something new, to know that we need to learn in order to be successful, and that this ain't easy, So hopefully we've tempered the threat of overly optimistic beliefs. Thanks for bearing with me. All right, let's talk about cycles. Especially as I'm doing short-term intraday cycles in the markets here. Why do I think that there should be cycles, intraday cycles in the markets? Well, human beings are dominated by cycles, and so is the biosphere. It's like nothing but cycles. The idea that we wouldn't see cycles in the markets seems absurd and preposterous to me. Cycles in markets are mostly driven by the collective behaviors of human beings. That's what markets are. I do think some cycles are connected to external forces. One of the things I've been doing some research on, along with other board members of the foundation, are geomagnetic and solar cycles. And Dewey talking about that in his book, 50 years ago. Research done by leaders at the foundation, Charles Greeley Abbott, the head of the Smithsonian, the secretary of the Smithsonian, and others, Ellsworth Huntington at Yale University, all looking into these relationships about the sun and biological life. It's an obvious relationship. It's kind of ridiculous to think that there wouldn't be something there, right? So more on that to come. All right, we use digital signal processing, statistical validation, and looking at the cycles, visual confirmation. We don't fully understand cycles, and that's okay. Jim Simons just passed away, the GOAT of markets, greatest of all time. He didn't understand what his models were necessarily cause and effect, but he was the GOAT. All right, and we are partly puppets on strings. And it's better to cooperate with the puppeteers. Like, that's why we have to learn about cycles, cooperate with cycles. Dewey talked about it in the beginning of his book. Also, it's kind of unpleasant, this idea that we might not be in control of everything, right? That we might be puppets on a string, so to speak. And that's what's offensive, especially here in the West, to many about cycles, and why they're not really embraced by the media. But that is our opportunity. It's our opportunity, if we can be humble enough to acknowledge that there are forces beyond our control that we are subject to, if we can start to study those forces, and if we can start to integrate an understanding of those forces into our own decision-making, it can be a huge help. So last thing before we get to actually looking at some charts, I went to DALL-E, the OpenAI image generator, and I said, please make me a picture that expresses the idea that man is just a puppet on a string. And it generated this image, which was really amazing because I spent like half an hour trying to go through, all the different stock photo libraries looking for an image of a puppet on a string. And then I asked DALL-E to generate this one. And in, a second, I had this image. And it's quite a remarkable image that unexpectedly is some really interesting things to me. Like, I think it's interesting, the idea that you have a puppet on a string here. You have gears and cogs and mechanisms, and then you have winds and something a little cosmic going on there. But it's interesting how he's sitting in the strings, right? He's not like fully subject to the strings. He's looking up. He's cooperating with the cycles. He's balancing himself, with the strings. So I just was very struck by this image. And I think it's a great image of how when we seek to understand cycles and we cooperate with cycles instead of pretending somehow that they don't exist, which is just absurd, we can live a more effective life, make more effective decisions, and do better in the markets. So thank you for listening to my preamble. And now we'll move on. And yeah, thanks, Bliss2B. Yeah, it was a really cool image, isn't it? And I will try to keep track of questions as we go. All right, so let's jump over here. Whoops, giving away the farm here before we even get started. And here I am at our Cycles Analyzer, app.cycles.org here. And I'm using the Analyst Pro version here. So this is our advanced version of our software that allows me to do intraday analysis on anything that I'm interested in. So here are my live streams. These are all the things that I track. So Bitcoin, 20 minutes, 2 hours, 2 minutes, 30 minutes, 4 hours, etc. And here are my futures, E-mini futures, 1 minute, 20 minute, 2 hours. And I'm going to start here at the 2 hour. So I'm doing a scan of the 2 hour bars on the E-mini futures here, E-mini S&P futures. And by default, the Cycle Analyzer uses 850 bars. And we can see that all here. It goes back to about March 19th. And each bar is 2 hours. And there's 23 hours in the futures markets each day, 5 days a week. So there's about 115 hours in the futures markets each week. And right away, we can see some cycles. There's a 117 cycle here and a 349 cycle here. And I think those are pretty close to a 1-3 relationship. We can go to the harmonics here and look. And sure enough, the 349 and the 117 are connected. So right away, we've got some interesting prominent cycles with good distinction on the cycle spectrum. Okay. Identified by the AI as cycle number 1 and cycle number 2. And pretty interesting. And short term, anticipated this. Well, let's, here we are right now. Let's see, there's this 349 seems to have bottomed. And the 117 has bottomed, but the 349 has not, is topping actually. So we have a little bit of tension between these two. And again, the 117 and the 349. So, all right, so good that we found some cycles early on that are interesting. We can turn on the cyclic RSI. This is another thing that I use a lot. It's basically a momentum indicator developed by Lars. And let's just stick with the 117 cycle here for starters. It's the number 1 cycle. 117 is what I just said. There was 115 hours a week in the futures markets. So this is essentially 117. It's very close to 115, but these are 2 hour bars. So this is essentially a 2-week cycle, 1 week from bottom to top. Okay, so here's the 5th of June to the 12th of June, and then the 12th of June to the 19th of June. So interesting, right? Right away, just, a simple run shows a 1 week cycle. It's a 2 week cycle, sorry, but 1 week, going one way and the next week going the other way. So interesting. Not surprising that, we kind of get an idea of what happened in 1 week, and then we go into the next week and we say, well, could we just repeat last week? Probably not. I think I'll lean a little bit in the other direction. Whatever it is that, I don't know where weeks come from, period. But there's a weekly cycle in the futures in the S&P 500. We basically had a good week from the 12th to the 19th, and the 19th to the 25th, today we're in about the 26th. It's been not as good, right? Not a significant down move, but certainly not an up move. And now we're starting to lean into the up move here. So meanwhile, I usually look further than just what the initial 850 bars tells me. I like to add more data to my intraday analyses. So I'll oftentimes add another 200 bars to the analysis here. Right now, you can see them that they're out of sample. Okay. And then I just click here to reset range. And what I want to see in particular is that cycle in the spectrum down here persisting. So the 118, the 117 became the 118, fell off a little bit. We see another cycle here emerging a little bit at 201. Can add another 200 bars. Oh, the 117 is now the 121 when we integrate more historical data. Okay. Can add another 200 bars. Reset the range. Again, now it's lengthening a little bit. It's about 124. So this is how cycles work. They're not static. They're dynamic. That's why we do dynamic cycles analysis. They move around a little bit. We can say, what their average is or their nominal, but they do tend to move around and they do tend to wax and wane. And I've got a animation that I've made you that I've never shown this before. So here is, here's the E-mini S&P. Excuse me while I just get a little drink of water. So this is starting out with 850 bars, and this is the spectrum, okay? So if I went back here, this is the spectrum here. We've added more data, but if we looked at the initial 850 bars only, it would be pretty close to where we are right here. So as we add more data to the analysis, I'm going to show you how this spectrum changes. Here's about our 115, our weekly cycle right here. This is probably a 2-week cycle. This is a 3-week cycle, right? And so we can kind of step through time, add more data now back to February 22nd, and we can see that the spectrum changes. So I am looking for the cycles that have persisted over time. Maybe they're not as strong in the latest under 850 bars, but I want to see cycles that persist. And you can see here now I'm going actually back, so not fair to you to not know which key direction I'm going. So let me just keep going, adding more data here. This is back to February 12th, January 31st, January 5th, and we can see this cycle here continuing to persist throughout the historical data. As we go back and add more data, it's getting a little, finally it starts to bifurcate a bit. Oh, now it's back. Still a lot going on here around 100 and 110, even though it's a little bifurcated. So I hope that what this illustrates is, one, that we're looking for cycles that are persistent. As we add more data, actually, you can see some of the longer term cycles coming into greater clarity. This 300 period cycle is another one that I see a lot across the equity markets on the 2-hour bars. Okay. Look at that. You know, the more data we add, that 300 period cycle is there. And this is now all the way back to the beginning of 2023. So this is how I approach intraday cycles analysis. And using this approach, this is what I found. Again, I haven't shared this before with the public, but this is my master spreadsheet that I look at what's going on with the 20-minute cycles, the 2-hour cycles, the daily cycles, and the weekly cycles. And I look at it for these assets. This is equities futures here, right? These are bond futures, metals, cryptos, energy, and some currencies. And these are all futures. They trade 23 hours a day. They're liquid. I can get in or out of them 23 hours a day without having to worry about odd market hours. And that's what I've been trading and developing. So these are my cycles indicator columns. Oops, try that again. And one of the things I really like to see is what's happening across the complex. So right now, all of my cycles on the 20-minute, the 2-hour, and the daily are largely negative across all of the equities. In addition to that, and we'll look at some of these cycles, okay? I also look at trend, 20-minute trend, 2-hour trend, daily and weekly trend, because I always want to know when I'm trading against the trend. I ideally want to be trading with the trend. If I have to, sometimes I'll trade against the trend, but right now, all the equity cycles that I care about, particularly the 2-hour, which is my sweet spot that I personally focus on, because that's the time period that works for me. But sometimes I want to jump down to and kind of anticipate what might be coming up in the 2-hour, and ultimately want to get positioned into longer term trades over time. So right now, you know, even though the cycles are nicely bearish, and we'll look at some of these on the equities. Okay, that's what I'm focused on. -1 means bearish. -2 means bearish with a cyclic RSI sell signal. Okay, +2 means bullish with a cyclic RSI buy signal. So it's just, you know, 2, 1, 0, -1, or -2. But I'm trading against the trend. The trends are up in cycles in equities right now. They're still up. Maybe a little wavering of the short-term trend in the Russell, but we have not broken support levels in any meaningful way on the equities. One of the biggest mistakes I see people make with cycles is to look at this and go, oh my goodness, look at how all these cycles have turned red now. I better short the market, back up the truck. No, doesn't work that way. To me, cycles are an arrow in my quiver. Okay, I think of them as which way the wind's blowing. Doesn't necessarily mean things have to go down, right? We were just looking at what's been happening with this 117, 120-ish market cycle here in the 2 hours on the E-mini, and we can see that you know, it stopped the ascent, but hasn't been a big downturn, right? We're fighting these positive trends. So we have to look at trends and cycles I also look at seasonals, sentiment. This is commitment of traders and daily sentiment index, and a little bit of support and resistance as well. And I'm looking at this throughout the day. I'm looking at the complexes, right? I can see here that bonds have negative cycles and a little bit of negative trends on the shorter term. But look, things are, pretty positive on the weekly cycle. So most of this is a correction still in a larger uptrend. So that's how I approach short-term cycles. I'm focused here on the 2 hours, but I'm also looking at either side, a fractal approach, you could call it, at a lower time frame and a higher time frame. So let's go look at a few of the other cycles here. So we looked at the E-mini, and these are my cycles. This is a lot of work here. Been monitoring them for over a year. They're the cycles that I've found to be persistent and effective and work for the kind of trading and the kind of time frame that I'm doing. So let's look at the NASDAQ. 2 hour cycles. Here we are. This 301 in the NASDAQ here. One thing I forgot to say that's important is in this work that we've been doing over the past year, I have found that cycles work best for me when I anchor on a big recent high or a big recent low. So here you can see in the NASDAQ, I'm anchoring my start point of this analysis back at this October 23 low. I'm using almost 2,000 bars here, 1,957 bars. Okay, it's a lot more than 850. And but I'm also looking at a longer term cycle, this 301. So it's been working well. We got the sell signal right about here, right at the top of the cycle. This light blue stuff here is out of sample, right? So this was the forecast right here. Went right up into the top. Got a cyclic RSI sell signal right here. And, now we're into this down leg of the cycle. Meanwhile, hasn't gone straight down, didn't fall off a cliff, right? It's come back the last few days. It's flatlined. Guess we're waiting for the Biden-Trump debate tomorrow night or the PCE that comes out on Friday morning. But that's just how cycles work. They're one tool, right? We can update this analysis to incorporate all the latest data here. And that 301 still sticks around as the #1 cycle. The momentum has bounced a bit, but turning back down as of the end of today. The NASDAQ and the S&P 500 are very similar. So if I just open up the same cycle I've been tracking on the S&P 500, similar cycle, 299 right here. And this 388 is also a good one. Got an incredible Bartels at 91. And then oftentimes I'll pull in, this 110, 120 cycle here as well. So definitely cycles topping here in the E-mini as well. The cycles that I've been following, that I've identified as being reliable and persistent. So let me grab all the latest data here. Again, got this 111, 300, 388. If you want to pull that into, maybe a little more lift, but definitely we got some negative momentum here. I think that 386 is the one that's kind of driving that up move. Let's see here. Or maybe it's the 111. Yeah, it's the 111 that's bullish here for another few days. All right, so that's what I'm seeing on the S&P 500. And let's look at the Dow. The cycles are different in the Dow than they are in the S&P 500 or in the NASDAQ. They're similar in the NASDAQ and the S&P. Different in the Dow. We've got, we do have this 123, 231. We go back and anchor on that October 23 low. Pull in all the latest data. See what we got. Again, this 120 here. Got a good sell signal from the cyclic RSI and a down move in the cycle on the number 2 cycle, right? Then we also have this 398 right out here at the tip. Again, maybe a little more lift. Again, this is which way the wind blows, okay? I'm keeping an eye on it all here on my spreadsheet, but I've definitely seen the cycles in equities turning down, going into bearish phases. Have to keep in mind that the trend is still on the side of the bulls. We don't want to pretend that it isn't. We don't want, cycles are counter trend, right? If a trend goes on for a long time, the cycles are going to start saying, hey, we got to change trend here. But no, we don't. Trend can override cycles for whatever reason. Seasonality is also pretty bullish in equities through at least the first couple of weeks of July. Sentiment is bearish from the commercials and bearish from the small trader who's gotten really bullish, basically, and you want to take the opposite side. So that is the general approach of how I'm doing intraday cycles analysis and what I'm seeing in the equity markets. Let me take a quick look over at questions. I see 300 period cycle. Yep. Okay. Nothing jumping out as very pressing. So let me continue on for just a few more minutes. I just wanted to show you a couple of things again about trading. I hope this isn't too much, but I think this is really important. So this is my own Jupyter notebook, it's called, where I manage my portfolio and my positions. I've been developing these ideas here in this notebook and then integrating them over here at RiskSmith, which is a free risk management service. It's still coming along. It doesn't do everything I want it to do, but I've made some good progress. So I just wanted to show you here, these are actually my current positions. Short 3 Russells right now. Short 2 golds right now. Short 1 Bitcoin. Long a little Ethereum. Short some crude oil. Long some yen, and yep, that's how it was earlier today. So here's my portfolio, and my diversification score for this portfolio is 53%, which is good. I like it to be above 50%, and my exposure is $13,500. That's kind of my worst case scenario if everything went against me all day long. Kind of my worst possible day. So let's see, is somebody, that's good. Okay. All right. So what I want to show you here is that this is my table here that I call my possible trades table. These are all the other trades I could make, right? Because I showed you these are the things that I trade. So I could go short or long any of these other assets here. And I've sorted this table by correlation to my existing portfolio. I said I trade uncorrelated assets. So the least correlated opportunity to my current portfolio was earlier today was the euro. And if I went long the euro, I could actually increase my diversification by about 6 percentage points, and it would reduce my exposure by $550. So I know this is a little complex. I just want you to know this is possible. And I'm going to be talking about this more in the weeks and months ahead. But let me show you what happened when I took this same portfolio. I didn't sell anything. Okay. I used more capital and I added another position in the euro, long the euro, that was, I learned about from, what's the least correlated next good bet I could make. So let's go down here to portfolio B now, where I added it in. And indeed, my diversification by adding in that euro trade went up to 6 points to 58%. And my exposure actually went down by about $500. So I took another $5,000 of risk in the euro, because that's my average risk size per position. But my net exposure of my whole portfolio went down. That is the power of uncorrelated bets. So when we can put together, 3, 4, 5 uncorrelated bets. By the way, why did I like the long euro trade? Well, here it is right down here. Okay. Yes, the trends are against me, but the cycles on the hour, 2 hour, the daily, and the weekly are all up. There were some really nice, you can actually go look at the cycles in the euro. I was down here. So the 2 hour. This was, earlier today with the cycles turning up. We can go look at the 20-minute cycles. Got a nice, strong, prominent cycle here. Adding in the silk RSI, got kind of momentum bottoming, coming into a bottom on a very prominent cycle here. Interested in dipping my toes into this one. It's an uncorrelated bet with my existing portfolio, and I get free exposure. Last thing I want to show you for the traders out there, this is just my correlation matrix for all the different things I trade. What I really want to highlight here is this US dollar. The US dollar is negatively correlated to almost everything else except natural gas, which is just, as far as I can tell, a totally random market. But I pay close attention to what's going on with the dollar, because if the dollar is rising like it was today, okay, I want to know that, because that is a headwind against basically all my other possible trades in the markets. So even if I see, a short-term good cycle turning up, but the dollar is making new highs, that's something that I take into consideration with my trading. All right, I'm going to leave it there. I know I covered a lot. Let me stop sharing now and come back to the screen here. Get you guys back on screen number 1. All right. Hello, Ron.
Hey, Richard. Fantastic insights. Covered lots of important ground in terms of, well, intraday cycles is a case in point. The fact that we haven't been able to do that ever.
I know. I go into the archives and I see the meticulous, painful, handwritten notes, that Dewey and others were doing for decades, right? And to think that we can take this same technology now and do intraday, cycles analysis in real time is mind-boggling.
What's your take in terms of some of the key areas that you focused on? So intraday cycles, the importance of risk management, not lining up with all the signals, whether it be time or versus trend. There are a lot of really important insights that you shared there, but maybe we start right at the top in terms of the psychology of trading the cycles, because I know that's a big part of a focus that we both share.
I mean, I think
traders often have challenges with.
Cycles can be very seductive, because you do see sometimes regularly, actually, they make absolutely spot on, mind-boggling, accurate predictions. And you look at that and you say, oh my goodness, I think I've found the Holy Grail. I have found that to be a big problem, right? So we have to be careful with cycles. And especially, I didn't show this, but the daily cycles started to turn over a couple weeks ago on the equities. And one of the things that kept me from shorting was that the 2-hour cycles were quite bullish still, and giving perfect, momentum buy triggers together with a cycle bottom on cycles that I've seen, hang around and be persistent for a long time. So that helped me to not, jump the gun on the daily cycle, especially when the trends were also very positive. We can't pretend that trend doesn't matter, that we have a magic bullet here to tell us when the trend's going to change. No, we have to respect trend. I think we have to use cycles and trend together. I love Jake's sentiment approach of looking for where do you have excessive sentiment leaning in one direction or another to help us find those big trades. I'm really interested in the Japanese yen right now. I think that could be a good, trade to the long side eventually. But right now, it's been a beautiful trade to the short side for longer than anybody ever could have conceived, So we have to be careful with cycles. I try to go out of my way to make it clear to people this isn't a holy grail, that, it can be seductive. Don't have overly optimistic beliefs, but definitely integrate them into your quiver. And nowhere can you do that like you can here at the foundation, especially with this intraday technology.
We have a follow-up question from Dr. Barton about how you define trend in the spreadsheet matrix. Do you find that, and also as a follow-up to that, do you find the NASDAQ moves faster than the S&P 500?
The trends are generally pretty simple. I just want to know basically, which direction things are going. And we back test a lot of different trend indicators. They are proprietary. We find some that work for us, but even if you use just simple like 50-day, 200-day, 50 period or 200 period crosses, etc., don't get overly complicated. Simpler is better. Really, it's about coming up with a system that you can follow, that you can stick to, that gives you a little bit of an edge and that you use risk management with and you get experience with. It's like learning to play the piano. It's like learning to play a musical instrument. You have to practice. You have to get a feel for it. And then you have to use your human intelligence, not just the machine intelligence, not the intelligence of another human, but your own human intelligence to observe, to experience, to get a feel, to develop an intuition, right? That's what great performers do. And trading is a kind of performance. And so that is ultimately the most important thing. And that's why I say, whiners are losers. If you think you're going to come and just get like a signal from somebody else that's going to make you rich, no, it will never work. You've got to do the work. You've got to use the tools. Yeah, learn from people who have gone before you, who are bringing you good insights and information. But ultimately, you got to own it, and you got to practice, and you got to, spend a lot of time at it.
And just to add to that, you had a great point at the end on diversification, just how powerful it is.
I can't believe that people don't know about this. Professionals know about it, but I just showed that briefly because it was a free trade. It was a free trade. It actually reduced the net volatility of my portfolio by putting on a trade that, it didn't come to my attention right away because, it's not as sexy as the NASDAQ and Bitcoin and crude oil, et cetera. You're like, the euro? Okay. But, it's like showing up there. Hey, here's a free trade for you. Oh, let's go look at it. Oh my goodness. Wow. That's a great setup. I love it when that happens because I'm getting these, it's like a setup that I would have missed, right? If I hadn't had another way of bringing it to my attention, instead of letting all the talking heads, tell me what I should be paying attention to, right? So having a set of assets, a diversified set of assets that you can monitor signals on and trade in and out of, I've found is a really great tool. One for kind of, helping tamp down the volatility, helping my expectations, stay aligned with where I'm at in terms of how much time I can commit to the markets, what's in my bank account, et cetera. So
what's interesting about that is that it was a benefit of risk management as well as new trade setups. And then I noticed right at the end, you highlighted the dollar as being very interesting.
Yeah, the dollar. I always watch the dollar. If you're doing intraday trading, you got to be watching the dollar. And I never hear anybody talk about it really, because it's negatively correlated to everything if you're in the US dollar. So when you see the dollar breaking out to new highs like it did today, watch out for everything else.
We have a few questions in the chat, Richard. I believe the first one from Mike. Why did you settle on 20 minutes and 120 minutes? So why those timeframes? Yeah,
so it's a great question, Mike. The 2-hour time frame is what I really settled on because I was looking at 30-minute charts and then hour charts. But because I can't sit at my desk all day long watching markets, I just couldn't manage those positions. So I had to go to a 2-hour time frame because that basically gave, the cycles that I focus on tend to be 100 periods or longer. And that gave me 1 to 2 week moves. And I use that 2-hour period to manage my expectations about kind of what my worst case scenario would be, right? So that's very important. So zeroing in on what is your time period that works for you, both in terms of how much time you can spend at your desk, and number two, how much volatility you can endure, relative to your account size. Okay. That's why I settled on the 2-hour time frame, not because the cycles were better there. It's because that's what worked for me in terms of the time I had available and the volatility I could endure. How long can I stand, to have things go against me? So, and then the 20-minute is just basically, 2 hours is 120 minutes. So that's about a sixth. I probably could do a 15-minute, but I stumbled onto the 20-minute, and that's kind of my lower level fractal. So I use that to sometimes try to anticipate entries and exits around the 2-hour.
And we have a grand finale question from another member on how FSC community members can access your ideas, charts.
So I am doing a regular show now on Tuesdays at noon Eastern time on YouTube, where I'm covering this intraday approach to cycles analysis and how I'm integrating cycles. If you're a member of the FSC, you have access to our basic cycles package. If you become a member of the Analyst Pro, I think it's $995 a year. Then you can get the intraday analytics that I've been using and that I was showing today as well. So all of that goes to support the FSC. We are a not-for-profit, and we're bringing all this to you for free. But those of you who do want to use it, you also get to know that you're supporting the research and the ongoing development. I mean, it's, believe me, Lars and I are still way in the hole for what we've brought to the FSC with this technology. So if you're interested in it, I hope you'll sign up for the Analyst Pro and help support the FSC and get access to these tools.
Thank you, Richard, for sharing the follow-up and for the key insights in the presentation. We still have an exciting day 3 to follow. And just as a preamble to everyone who's looking forward to that, FSC board members Bill Sarubi talking about US stocks 2024 into 2025. Andrew Pancholi talking about another subject of interest, the power of roadmaps. There are no black swans, tongue-in-cheek insight there that I'm sure will be shared. So do tune in for that. Also, for those of you who've been asking, replays on YouTube will be available on the day as soon as we close. So that is already readily available per session. Remember to explore our FSC membership privileges. For those of you who are new to the foundation, select the link in the chat for our free FSC newsletter. And just to add to what Richard just said there, reminder, FSC is part of a greater good mission as a nonprofit. Our work is made possible by membership dues and donations, all of which are appreciated. Thank you very much, and appreciated, Richard, for your session.
Thank you, Ron. Great hosting, and thank you so much, everybody, for joining us. It's great to have you, and we hope to see you again soon.
Take care. See you tomorrow.